Hello, this is Ken Tomko with T2 Asset Management, doing our monthly review of what's going on in the markets. As always, please don't use these for trading purposes. They're for education only, and a review of what we are doing in our portfolios. I always start here with the chart of the S&P 500 weekly. Each one of these candlesticks represents a week's trading. So this goes back to 2018 all the way here on the left side. You can see 2019 was a decent year. COVID was right here, the sell-off, 2020, and then all the money that poured into the markets and goosed them up higher. That led to inflation and then led to the Federal Reserve having to tighten interest rates. And that's what we see here that caused a bear market for 2022. Currently, I have highlighted sort of the range that I'm looking at here, that we're in a sideways market. It's just in back and forth. We really haven't gone anywhere in a year. In fact, we're almost exactly where we were a year ago. And market seems to be trying to maybe break out of that range, but it hasn't quite happened yet. And we're characterizing this as a sideways market. If we come down here into a little more detail, this is the daily chart of the S&P 500. And this gives us about maybe 2 years look at trading. We see 2022 here was just super choppy, back and forth, all over the place. Grinding downward for sure, but all over the place. And then now, since last summer, we've come into this tightening range. As you can see, the triangle that I put on here, that market's trying to figure out what the next move is. And it probably has quite a bit to do with what the Federal Reserve is doing. If they're done raising interest rates, or maybe even going to cut them a little bit, we might see a little bit of growth in the markets finally, which would be nice. It hasn't gone anywhere, as I said, in a year. But we're trying to break out to the high side here. It just maybe hasn't quite happened just yet. So go to our next one. This gives us a 2-hour look at the each one of these is 2 hours trading in the S&P 500. It gives us about a 6-month look at where we are, and you can see the recent rally coming from March, and then went sideways here for a month or so, and now we're trying to move higher, and we'll see what happens there. But it gives us a nice short-term view of what we're seeing in the trading. I do want to go back here to the daily chart. One of the things that we look at is the internals, the breadth measure. Sometimes it's not just what the market's doing, but what are the stocks underneath doing? And if we come down here to the advanced decline line for the New York Stock Exchange, we show that gives us an idea of, like, are there more advancers or decliners in the broad market? As you can see here, for the year, it's pretty flat. Even though the market has moved a bit higher, the overall breadth of the market has stayed kind of flat. And then this next one down is the percentage of the S&P 500 that's in an uptrend. And right now that's sitting at about 45%. Usually in major uptrends, we would see it somewhere around 80. It just doesn't go back far enough, but you can see it go 90 or even 100 sometimes. But right now it's a very thin number of stocks that are rallying and causing the breakout, and that's concerning. And finally, the bottom here, we have the VIX, the volatility index. And this is the cost of insurance premiums in the options market, and that's really quite low and has been falling all year. So that kind of keeps us maybe a little bullish there too. I would characterize these as mixed, and that probably goes along very well with our sideways theme, that we're certainly not in a scary market. Hasn't shown up or anything like that yet, but we're also not in a raging bull market either. It's just a sideways action. So if we come over here to the culprit for all the troubles last year, this is the 10-year interest rate on U.S. Treasuries. And you can see, I mean, we were down here, it was about 0.5% was the interest rate on a 10-year bond. And now we're coming up to, we hit about 4.3 here, and right now it's coming off a little bit, 3.6, as people are betting that maybe the Fed will stop raising rates or even lower them. So that might be helpful for the stock market. But you can see that a couple of years here of raising interest rates definitely had an impact on the markets, as last year was terrible for stocks and for bonds. Then if we come over here to some of our economic indicators, look at what's going on under the hood. We have the latest GDP growth rate, 1.3, not great. Before that, it was 2.6 on that reading. But these are still positive numbers, so let's keep that in mind. It's not terrible. It's just slow. Non-farm payrolls here, we added 253,000 in the last look, which was better than the previous time. So again, positive. We're not seeing, and then there's unemployment there. We're not seeing this tick up to really big numbers. So we have to keep that in mind. Retail sales here, that's another that I look at. It was positive for the month. The previous reading had been pretty poor. It is coming back around. So maybe we're not seeing anything too much yet in the economic indicators that are telling us that things are bad, even though there's a lot of people forecasting that, but haven't seen it as of yet. And if we come over here to, this is an analyst estimate of forward earnings on the S&P 500. So all the large Wall Street corporations, their analysts will get together and say, this is what we think are going to be earnings for the coming quarters. And you can see it's rising. They're basically saying that S&P earnings are going to be quite good no matter what the economic backdrop is. So far, they're projecting excellent numbers going forward. So I think we have a lot to be positive about there. We'll see. Definitely watch some of these rotations. I go in and keep a list of. This is a 3-month look, and you can see the S&P 500. And what's really been working is the Qs, the Nasdaq. Some of the growth stocks, that's what's really driving it right now, in a limited number of names on that. We go over to the fixed income side. Same thing. This is the bond index. It's up about 3% over the last 3 months, and take a look at what some of the themes are. But I'd say it's fairly risk off in the bond market. So back to our weekly chart. It's a sideways market. The way generally would advise looking at that is this might be a good time to get in and get dividend payers, things that are going to pay you a little bit of a premium to go sideways for the time being. And it is kind of nice that right now a 1-year U.S. Treasury bond, those are paying in the fours. So you can get a little bit of money to go sideways while we wait and see how this resolves. It does look like it's trying to break out and move higher, but I wouldn't say that has happened yet. So we'll be sitting back and waiting a little bit. So do hope this was helpful and informative. And if you'd like to hear more about what we're doing in our portfolios, please do reach out. Otherwise, hope it was helpful, and see you at the next update. Thanks so much.